welcome back to the Dukascopy TV studio. I'm Natalie MacDonald. Joining us next in the studio is Charles-Henri Monchau of EFG. Charles-Henri, thank you very much for coming in today.
Thank you.
Now, we're going to be looking today at commodities trading. And prior to the last 12 months, commodities had really outperformed equities. However, this trend seems to have met with an abrupt reversal, as it were. Can you expand on what appears to be the end of the commodities supercycle?
Sure. Well, indeed, commodities had a fantastic run over the last 15 years. This was driven by growth in emerging markets and China, and this has led investors to talk about commodities supercycle. But this has come to a halt over the last few years. Main reason behind that is that China is rebalancing from investment-led growth to consumer-oriented growth. There is indeed a high correlation between the growth of industrial production in China and the prices of raw materials. And if you look over the last few years, we have seen industrial production growth in China slowing down, and this has led raw prices to decline and thus commodity prices to decline. So that's for the demand side of the equation. On the supply side, years of rising commodity prices have pushed companies, firms to increase production. So that means that the supply situation is clearly a headwind for commodities, and this explains why commodities have been underperforming equities over the last few years.
If we split this discussion then into strategic and tactical perspectives, you've commented previously that from a strategic point of view at present, with this underperformance in mind, there are no grounds to automatically include commodities in a global portfolio. Talk us through this methodology.
Yeah, sure. So many investors believe that if you include commodities in a global portfolio, you're going to automatically improve the risk-reward of the portfolio. That's actually not true. Indeed, the first point is that when you invest into commodities, there is no income generated. It's a pure bet on the price increase of commodities. So it's true that, if you look at history, there are some periods of time when commodity prices have been doing very well, but it has always been very volatile. So if you invest into commodities, the increased return you can get on your portfolio is offset by the increase of volatility. So that's the first point. The second point is about drawdown. If you look at the drawdown of commodities, it's actually worse than the equities drawdown. And while there is, in the long run, a low correlation between commodities and equities, we can see that when there is a drawdown in equities, it is usually associated with a drawdown in commodities. And the last example was in 2008. Okay? And last but not least, there are also trading costs and pitfalls associated when investing into commodities, funds, and ETF. One example is when you invest into commodities which have a curve which is in contango, and then you have the cost of the roll which is associated. No? So this all seems to suggest that there are no grounds to automatically include commodities in a portfolio, but for sure there are periods of time where it is desirable to add global commodities or specific commodities to a global portfolio.
However, from a tactical standpoint, you highlight the relationship between a forecasted rise in growth and an anticipated pickup in commodity prices. So talk us through then the commodity pros for investors.
We indeed expect a pickup in global growth in 2014 and beyond. So that should be a positive for the demands in commodities. In the same time, we don't expect a big increase in supply. So overall, the supply-demand situation is rather favorable for commodities. That being said, we don't believe it's going to be 2009, 2010 again, when China saved global growth by boosting demands. So we believe that in the next commodity bull run, you will have to be very selective.
What then is your response to this trend? Will you be avoiding commodities altogether, or is it simply a case of being more selective in your investment strategy?
Well, we believe it is worth watching those commodities which have fallen long enough and far enough to force involuntary cuts in production and to spur fresh demand. And that's the case, for instance, of copper or natural gas. But rather than invest into those commodities, we prefer to invest in the stocks that are tied to these commodities. Indeed, markets and sectors which are tied to those commodities have been sharply underperforming global equities. If you look, for instance, at US materials or US energy stocks compared to the S&P 500, they have been sharply underperforming, and they now trade at a significant discount to the market. And that means that at some point, the risk reward is gonna become attractive. So one example is, for instance, energy stocks. If you want to get exposed to the demands of emerging markets or to inflation, by investing into large oil and gas exploration and production companies, that might be a very good investment, especially if they trade at a sharp discount to the market.
Dr. thank you very much for coming in and sharing your insight with us.
Thank you.
We'll be back shortly with more exclusive interviews, but for now, goodbye.